What is the SOFR Index? Have you ever wondered how interest rates are determined in the financial world? Today, we are going to talk about the Secured Overnight Financing Rate Index, commonly known as SOFR. This index is a benchmark interest rate that reflects the cost of borrowing cash overnight, using United States Treasury securities as collateral. It plays a vital role in the financial systems and institutions we rely on every day. SOFR serves as a key reference rate for variable interest loans and financial contracts in the United States. It replaced the London Interbank Offered Rate, often referred to as LIBOR, as the primary standard in 2022. This shift was significant, as SOFR is based on actual transactions in the overnight repurchase agreement market. In this market, banks and financial institutions borrow and lend cash secured by Treasury bonds, which reduces credit risk. One of the standout features of SOFR is its transparency. It is derived from a large volume of observable market transactions, totaling over $1 trillion daily. This makes SOFR more reliable and less susceptible to manipulation compared to LIBOR, which relied on unsecured interbank lending estimates. The Federal Reserve Bank of New York publishes the rate daily, calculated as a volume-weighted median of transaction-level data from various repo markets. Unlike LIBOR, which could be set for multiple time horizons, SOFR is strictly an overnight rate. This means it reflects the immediate cost of secured borrowing but does not predict future interest rates. In capitalist financial systems, the SOFR index provides a stable, market-based benchmark that supports efficient pricing of loans, mortgages, and financial derivatives. For businesses and consumers, SOFR-based rates can lead to more accurate and fair interest costs. This promotes efficient capital allocation and supports economic growth. Banks and financial institutions use SOFR to set interest rates on adjustable-rate mortgages, corporate loans, and other credit products. When SOFR rises, borrowing costs typically increase, impacting loan repayments and investment decisions. Conversely, when SOFR falls, borrowing becomes cheaper, encouraging lending and spending. From a capitalism perspective, the SOFR index exemplifies how market-driven mechanisms establish reliable pricing benchmarks. These benchmarks facilitate lending, investment, and economic activity by reflecting supply and demand for secured short-term credit. This supports the functioning of financial markets and the broader economy by enabling risk assessment and resource allocation based on transparent, market-based information. In summary, the Secured Overnight Financing Rate Index is not just a number. It is a cornerstone of modern financial systems. Understanding SOFR helps us grasp how interest rates affect our daily lives and the economy as a whole.